G'day, listeners, and welcome to another episode of the Scouting Australia podcast, powered by Australian Property Scout Buyers Agency. I'm your host, Sammy Gordon, and I'm joined by my regular co-host and all-round good bloke, Jimmy. How are you, mate? Welcome back to the show.
G'day, Sammy, and g'day, listeners. Great to be back on the show. Thanks for having me back, dude. I'm always waiting for that phone call. I'm like a nervous date, just waiting to see if I'm going to get a call back. I appreciate it.
I can imagine, man. You got put on the sidelines last week. We had big Mr. Lukey Montgomery on the show sharing his story, mate. He trumped you. He's done extremely well.
Mate,
people have actually started putting the call in for him to be my co-host and to bin you. So, mate, you never know how soon that call or how far away that next call is.
But did he have the looks is what I'm asking. I'm not too sure. And you need let's face it, you need the diversity card. You need the diversity card.
Young versus old. Yes. Female versus male. I love it. Very good.
It was great
mate.
Listening to his story, though, and what an incredible turnaround, mate. That was awesome.
Yeah, it was unreal, mate. He's had quite a journey. For those of you who didn't listen to the poddy from last week, he turned a 250 grand loss between 2017 and 2019 and about a $600,000 gain from that kind of start of 2020 through to now. It was an amazing story, guys. So if you haven't listened to it, I strongly recommend you go back and listen to that investor story. Young fellow with a big drive and an ambition behind him. He's turned a big loss into a very, very big gain.
Can I just add something on that? Because I think that was a really important point. I know we're sort of digressing a little bit, but a lot of people with their investing start off and they get really down on themselves while making a wrong move or they're stuck somewhere. So if you're listening to this, and because I've been there, I don't know if you have, but I definitely have. Just for that inspiring story about someone who did turn it around, because when you're in the middle of the shit, so to speak, you're thinking, I don't know how I'm going to get out of this. So do yourself a favor, listeners. Get out there and listen to it. It was a cracker.
100%. Go back to that one, guys. It's a great one. And like I said at the end of that last episode, if there's anyone you think it's relevant to, you should be sending it on, because there's so many people out there that have been burnt by these sorts of stories and by the average little investment starts, and then they never go back and do anything else again. But they had the guts and the courage to get started. They just had to get back on the bandwagon. But Jimmy, mate, today's chat, it's a very, very interesting time in the market right now. We're in Feb, 2023. We've had so many consecutive rate rises, trying to curb this inflationary run that the country's on. It's very interesting, though, to note that we've also had some exceptional rental rises and raises as well. So whilst, yes, interest rate increases are real and interest rate repayments and mortgages and whatnot are going up, rents are very much going up to a similar sort of run as well. We've seen some of our areas are potentially 30% plus in terms of rental growth in a 12-month window. So it's kind of been growing hand in hand as it typically does with inflation. So it's an extremely interesting time. We're seeing a lot of big markets kind of pulling back, and a lot of your little markets and your more affordable markets really punching on and running forward. And showing strong growth like they did last year. And I think that they're priming up for another good run this year. And, mate, I thought it would be a great episode to get you in. And, mate, your age might have actually played a good card in this discussion because you've been around so long. You should be wise. I send you the little wizard emojis regularly to remind you. But, mate, I thought it might be a good idea to get you in and have a bit of a chat around how to actually pick a growth area, which a lot of people probably don't put us in that category as being the experts in that, which you and I have laughed about before, considering the success we've had together. But what do you reckon, mate? Did I set this one or what?
You know what? I'm glad. I was a bit surprised when you wrote this out there because here on the ground out there previously, and I know you've got a few things to say about this, but Sammy Gordon, the cash flow king, people have been saying, I thought APS is about cash flow. When you're comparing a differential between what you have done and APS and some of the competitors out there, some of them are listening. They're mainly focusing on growth, but some people have said, Sammy Gordon, no, he's a cash flow guy. He's always focusing on yield. So I'm actually quite curious to turn this back on you before we get into the metrics and all that. Now, I know the answer, but I'm trying to rile you up a bit. I'm trying to get a bit of burley in the water to get the bull shark firing. So tell all the listeners out there, is it true? Is Sammy Gordon APS, are you just a cash flow cowboy or do you have some growth in there?
So I have some growth in the tank, some personal growth, some market growth, mate. I think it's actually a really funny thing that people, typically place myself and APS, in that category, I guess, so to speak. Especially considering the LVR that I have on my portfolio compared to most people in the game. There's other people that try to out, they got 15, 20 million property, but they're running at 80, 90% LVRs. I've got the upper end of that size of a portfolio. I'm sitting at below 50% LVR. Now, it's very hard to pay that much off a portfolio. So how do you create that? How do you make that much wealth and actual net equity? And it's growth. I think a lot of people, mate, because of my background as well, probably put me in that hole of, I like just to go out and renovate and build shit and make stuff happen. But they don't realize how much time and effort, energy and resources I actually put into picking markets. I've always been a huge advocate, obviously, of making a margin on the way into a deal and actually, creating that equity at the start, at the very front end. But man, I'm a massive advocate of obviously doing that in the right markets that are also going to have strong growth and actually carry you forward for a really big run. Because that's where 80 to 90% of the result you're going to get out of that deal in terms of actual equity is going to come from the run of the market. So it doesn't matter what style of deal I execute, whether it's a growth play or a cash flow play or a manufactured equity play. It doesn't matter what it is. First and foremost, the first thing I always pick is actually the market and the growth market to begin with, to then layer those additional strategies on top. Because you can do all the good stuff, but if you're in an average market, all you're going to be able to do is pull it back out and roll it into something else. If you do all the good stuff and you roll it back out, and then that asset keeps growing, that's where the real gravy is, and that's where you really make those really, really big profits. And you would know this firsthand because of what we've obviously executed for and the results you've had out there as well. But I do find it quite funny, and sometimes I laugh and sometimes I get pissed off when I hear these other people touting themselves as growth experts, these growth gurus or whatnot, and we're in a market 6 to 12 months before they are, and by the time they get in, they've missed the bottom part of the market. They've missed all the they've missed all that dead stock that we've gone in and cleaned up on, and they've missed that first wave of growth. And they've also missed out on the opportunity to build all those relationships in that bottom end of the market before the market really turns.
It's interesting.
It's something I really pride myself on, mate.
Yeah, I would have to. I mean, obviously, I'm a big believer in that too, and I've been the beneficiary of that quite fortunately. I remember when we started doing some work together when we were buying in the Brizzy market, and those properties have had some significant growth up until now, even despite 100%. The pullback. The amount of growth that we've had has been substantial. And I even remember back then, when I was just getting into that market, you were already touting a different market.
Yes.
And I was like, dude, I'm just getting into this market. You're already going to another market. And actually, one thing that really impressed me with you was that you always said to me that you would be buying into the market first to test it out before you put any investor in there, because you just wanted to make sure the numbers stacked up.
Yeah.
So it is true. And I know I was just winding you up before about cash flow, but I think when you put up your portfolio and you said, your LVR at 50%, you can't get an LVR of 50% on a 20 mil portfolio unless you're down paying debt somehow. And you can't down pay debt unless the properties have grown. So clearly the strategy, I think the biggest difference that I've found from when I've chatted with other buyers agents and just knowing what else is in the market is that we've got the growth strategy, but then the cash flow strategy is the one that I find a lot of people are missing. I don't think they really understand that. They just think if it's positively geared, it's a cash flow property.
Yeah.
No. It's a very different thing.
100%. Yeah, man, there's so many different facets and layers to it. And yeah, just being like a couple of grand positive or a couple of grand negative or whatever, if you're sitting around that neutral sort of zone either side of it, you just call it a growth property. It's a growth property is doing a thing, and you should be moving on, executing different strategies from the cash flow perspective. Yes. I'm digressing. Yes. We're obviously on this poddy for the growth side of things.
No, we are about the metrics and stuff for people to understand. But I think what we're touching on is a really important element, right? Because you can pick the market and the market's going to do a lot of the heavy lifting for you. But if you're just relying on the market and you're not understanding that you can dictate the turn somehow, whether you're manufacturing equity or cash flow, then obviously you just want to give it that kick, right? So we're trying to squeeze every drop out of every dollar. So the metrics are really important, which you're going to uncover now and we're going to go through. But for the listeners out there, don't underestimate what you can do to the property and how many layers of strategies you can put on that deal to increase either equity or cash flow as well, right?
100%, man. 100%. And it's funny too, because like so often, and we'll dive into this, but so often, like what we really work through, it almost comes through as counterintuitive. It's almost like the opposite of what a lot of other people talk about, and the way that a lot of other people invest. But like the proof is in the pudding. With the growth rates we've had, you look at your portfolio, you look at Lukey's podcast last week, properties that we bought less than 3 years ago, kind of 2.5 years ago, have doubled in that time frame because we bought at the absolute bottom. Before the market turned, we made a nice discount on the way in, and then the growth you got on top, you're doubling your equity. And he's literally on his $250,000 loss. We turned and eliminated that on the first deal in a 2.5-year window in terms of a $250,000 gain. And we've got some other investor stories coming up soon that very, very similar stories happen, and some of them cashed out at over 100% profit margins in a 2 to 3 year window. Mate, you don't get that by flicking it or just targeting like a cash flow strategy or whatever. Like you said, you'd be very diligent in terms of picking these markets and buying at the right price and at the right time.
Yes. And as much as we're going to go through markets and different markets in a way and the metrics and stuff, you can't get them all right, though. Isn't that fair to say? I mean, it's impossible to be hitting every single market and be tapping into everything. I mean, there's only so many things you can do at one time. So when we go through this metric stuff, I'm curious from the bull shark himself, has there been, I want to know about the missed opportunities as well, because everyone's calling you Teflon. Nothing sticks. He just it's slick, gets it done. He's just smashing out results.
Yeah, 100%.
So, but there's got to be surely some time where you're like, you know what, I missed that market, or shit, I stuffed up there. Or
it's happened plenty of times. So like prime examples of it were when COVID rolled around. Man, I only had so much manpower between myself and the very small team that I had at the time to cover the markets that we entered, because what I really pride myself on is becoming extreme market experts, right? So like we'll pick a small handful of markets that we believe are the strongest growth markets in the country at the time, and then we become market experts at them. We create extremely deep relationships, get access to a lot of property that way and the best deals. But especially when we started, we had such a small team. I had to pick between markets, and I had to forego some markets that I knew had really strong growth potential, but I didn't have enough manpower to kind of stretch myself. And I would have been doing a disservice to myself and disservice to the clients to be producing probably half-assed deals, or in my opinion, what would probably be half-assed deals, what most people potentially would accept. But like we have a certain criterion and caliber that I like to stick to. So I didn't have the time or the resources, the manpower. And you look at COVID, there's a lot of those regional hubs, those regional centers that we essentially kind of passed on or just looked over or did very, very little in there at the time because of the growth that they had. I look at a lot of regional Vic, and I'm the first one to put my hand up and go, we missed that. But at the same time, a lot of those markets saw 50, 60, 70% growth. And a lot of my clients that instead I put into Southeast Queensland and Brisbane doubled their money. So while we missed some markets, there's no market we've put anyone in that hasn't performed. So all the markets we've put everyone into, the markets that we put clients into in 2019 and 2020 in Adelaide, most of those guys have doubled their money or gone very, very close to it, 70, 80% plus growth. Majority of clients we put into Brizzy, similar time, 2019, 2020, 2021, have had exceptional growth as well. And in the areas where we're extremely active in now, that we were in 2020, 21, 21, 22, and it really, hammered those markets and again, built those really, really good relationships, those resources, and created really good deals. All of those guys are way in front as well. So it's like, we haven't stuffed any markets. And I know the market's done heavy lifting or done lifting in most areas right around the country, but there's a difference between the market across the country doing 15 to 20% and our guys getting 30 to 40% in some instances per annum. So I definitely think we've strongly outperformed the averages. And while we missed some markets, we definitely have outperformed in the majority of markets as well.
We do get I do get a few questions from clients from time to time saying, "Oh, so tell me, I love listening to the poddy, and I love listening on watching on Instagram and seeing the success stories." And they do actually ask, "Well, what about the deals that haven't worked out, or has there been any stuff ups, or has there been any areas that just haven't done anything?" So you touched on it before, but I think that's an important point. So everyone has really performed to the level that you've wanted.
All areas that we've bought in has produced at least like continual double-digit growth. There's no one deal. I know every deal that's gone through the business. There's no one deal or one location that we I look back now and go, oh, shit, I shouldn't have bought in.
Hasn't gone backwards.
Nowhere. No,
No.
definitely not backwards. Or like, yeah, I guess there's some of those markets like Brizzy that might have gone up 110% since purchase, and then maybe came back 10 or 20% the past 12 months. They're still 90% up, you know? So it's, and markets do always fluctuate and they do move like that. And that's why it all depends on your exit strategy and what you're looking to do. But no, there's nowhere where we've bought and they've seen no growth, you know, from that perspective as well.
Just one final point on that one is,
yes.
So what about when you're looking at certain markets, right? And you're looking at the growth of them, and some of them are growing at different points. So some in the first 3 to 6 months might explode, and obviously timing's right. But some of them that might just try, you know, progress along.
Tick along.
So is it important not to get too caught up and too seduced in what's happening in the first 3 to 6 months? And sometimes we get a bit of a blinkers on and not looking at the bigger picture, thinking about the long term of what we're actually trying to achieve.
Yeah.
Do you find that?
Yeah, I mean, and the other thing to note and to remember as well is that like evaluations don't always come back exactly what you're expecting to straight away. A lot of people think it's going to be gospel because we've had, you know, a huge amount of clients come back after 3 months and get huge uplifts that it should and it has to happen on theirs. But realistically, it always comes down to an external source away from us that typically is quite conservative. So quite often it might take you, especially in a market like right now where there is a little bit more mortgage stress and risk around, value is being a lot more conservative. So it might take 6, 9, 12 months to get a proper accurate valuation, which at that point should be quite a bit higher. But yeah, man, like it's natural for, you know, to not expect markets to produce ridiculous growth in the first, you know, 3, 6, 12 months. But if you're making a nice solid chunk on the way in, and then the market does at least, you know, a double digit in the 12 months after, you're going to be sitting in a pretty prime spot.
Yes, Sammy, I love it. All right, well, now it's the time we've been waiting for is to get a few of the pearls of wisdom.
I know you had a few questions you
well, I did, mate,
because I haven't seen the list.
Well, I want to throw you on the spot. You know, right, I've been out of the game here for a week, so I've come back firing on all cylinders.
You look weathered as well. I thought you would have looked well rested, mate. You look weathered.
I do have an injury, mind you. So
he's torn his pec, guys. That's where he was away last week. He's torn a pec. He was doing 30 kilos on the barbell bench, and unfortunately, he tore a pec. It was too far above you.
We're going to go into property, but if anyone's listening out there and is over a certain age, just realize what you are capable of and understand that your ego, as much as your ego doesn't care about the numbers when it comes to investing, your ego shouldn't have anything to do with how many weights you lift or how heavy you lift. So
what age bracket are we talking about, Jimmy?
You know, 30 to 30 plus.
30? Come on, mate.
No, I'd say 40 plus. 40 plus.
Okay.
Just be realistic as to what kind of weight you lift. I know you don't mind your weights, as I can tell. Not so much on the nutrition side, but the weights, you're definitely lifting heavy. But anyway, I've torn my pec, everyone. That's why I wasn't on last week, but I'm glad the other team did a great job. Now, can I get into my question?
Has been said. But yeah, mate, great to have you back for.
Don't deflect from my questions. All right.
What was the question?
So obviously, there's a lot of data out there. There's an incredible amount of data that is, you know, when people are looking about investing. So there's so many different metrics. There's so many different aspects. But realistically, what I want to know and what the listeners want to know is what are the most important indicators that they should be looking at in a location for a place to invest? And I want to focus more on growth, if that's all right.
Okay. You say the trends?
Well, just the indicators or trends or the metrics, or let's not get too bogged down, but I just want people to get a clear picture of what they should be looking at.
So one of the tricky things with trends, right? Let's just talk about trends for a second. One of the trickiest things about trends is trends almost always come as lag data. So if we're talking about like supply and demand and let's say vacancies trending down and days on market trending down and listings trending down, your one slight issue with this scenario and where you're at within that, it's always lag data. So the market's already started moving in that direction of tightening up during that time frame. Doesn't mean you've missed the market if you pick it up, let's say 3 to 6 months after all those things have been really tightening up, but you might have missed the absolute bottom. So there are probably 3 or 4 things that I would really have a really good, strong look at that that constricting days on market are a really important one. Like as that starts to really tighten up, that means the market's firing up. But that is almost always like one of the kind of last indicators that a market's turned, when that starts getting really tight. But your listings is a big one, and supply to demand ratios are a big one too, in terms of how many people are looking and buying property, and how many properties are actually coming up for sale and listing and selling as well. So there's a lot of different things within that to really track. But yeah, they are really good ones to track. But they kind of more, if anything, show you're on the right track. So when they start to really constrict and tighten up, you're like, shit, okay, here we go. I'm on the right track here. Probably should speed up what we're doing.
So that means you're late to the party. If you're waiting on these things, you're a bit late to the party. It's a bit like you for a cross into the box and you've missed it. Strikers scored. You were in the midfield because your fitness wasn't up to it. But is that what you mean?
I get the knockback, mate. Yes, as the ball comes back out, and I smack it in from about 25 out. So I always got the knockback down. But yeah, mate, like, you're right. That lag in the data there is always going to make you miss that first little bit from that side. So it is a great indicator, but it's something to be wary of. If they are the only things you're tracking, which I know a lot of people hedge a lot of their stuff on, you're in a lag moment where you're going to be a little bit behind the game. There's a lot of other things to really look for and kind of factor into the equation. One of the big things too is if you are very active in a market that is doing quite well and it's early on in a cycle. Let's say you get into a market that was like that. There's nothing wrong with still toweling it up and still going quite hard or pushing hard to get a deal in that market. One of my biggest regrets is I bought in Sydney up until the market had about 20% worth of growth. And then I pulled the pin on it and I go, oh, it's had too much. I can't have that much more. It's probably going to come back. This was very early on in my investing days, not as a buyer's agent. This was back when I was, I think maybe 23, 24, something like that. Yeah, there you go. 2013, 2014, when the market really started to fire. It was one of my biggest regrets because of the amount of growth that those markets have had. But it was a great learning curve. Just because you've missed that first little bit, it doesn't mean you shouldn't buy. It just means be very wary, try and get a really good buy, but that you're probably onto the right location if it's already had a nice little run like that. But what you're trying to do is you're trying to preempt and actually get in there before that turn really starts to come about. One of the biggest things you can do is really track this from a macro level as well, looking at affordability rates and affordability perspective. Rising rents and one as well are a big one too, as your vacancies are falling. But as different areas are kind of peaking out and moving in that fashion, if you look at it like from a capital city perspective, one of the big reasons why I turned my attention towards Perth well before a lot of people did was because I could see Adelaide was having an exceptional run during COVID. Brisbane was having an exceptional run during COVID. Hobart was having an exceptional run during COVID. All of a sudden, a city like Perth, with one of the highest income states in the country, to take the ACT out of, is the highest income producing state per capita in the country in terms of a capital city, highest income producing, had the lowest median house price. That balance, like, it couldn't stay in effect, right? So the affordability of that area at the time was unbelievable. It was through the roof. It still is quite affordable for what it is compared to those incomes. It is a tiny bit more cyclical, and people have a bit of a negative connotation because of the little mining blip that it had in 2013, 2014. But it was a very different market to what it is today. So, what we obviously did when we noticed that big disparity was in there, that affordability to house price ratio was heavily out of whack, was I went over and I got on the ground there and I started chatting to people and getting into different markets and really assessing and finding those real gaps where those markets had started to tighten up a little bit and stock was starting to dry a tad and really kind of get into there. But because it was so early, it was so much fair game there as well. And everyone was really busy in these other markets, which were growing, and we were still buying there as well. But it was that early entry point and buying before people all of a sudden got priced out of Brizzy or Adelaide or Hobart, and those yields stopped working. And they started turning their attention into that other capital and those other markets. And so it was kind of beautiful timing where we bought in kind of 6 to 12 months before the run really started. And we bought, a lot of property like in that very, at a very discounted rate as well, because we were quite singular and by ourselves when we were buying there. So that's one of those big things, man. Like, and I think it's a really important one. A lot of people say you shouldn't be buying, it's a 50-50, right? Some people go, oh, you don't buy based on affordability. You buy where the high incomes are and all the rest of it. But you look in an environment like we are right now, like a high interest rate environment, which we were never going to stay as low as we had been. They were record lows, never seen before in terms of interest rates. Now, all of a sudden, we're up to these, not record highs, but kind of up to the average highs. But all these markets that were kind of at that slightly affordable or just affordable or kind of, in balance in terms of house price ratios to house price to income ratios. And then all of a sudden the interest rates more than double. And that just goes way out of whack. And what it means is that these markets then become extremely overvalued compared to the actual incomes in those areas because of what interest rates have done. There's only one thing that happens when areas become overvalued and people can no longer afford, for one, to buy them, for two, to afford to hold there as well. It starts to come back a bit. So it's kind of the opposite and the reverse thinking in terms of that strategy. Is you don't want to be buying into those areas. It's the same thing as people talking about, oh, you buy into the areas with this long-term capital growth, or this area's had 12, 13, 15% capital growth average over the last 10 years. I wouldn't touch it with a 50-foot barge pole. There's only one way that market's going, when interest rates go up, and it isn't further up. So I think it's a really important point to note, man. I think I labeled a big bunch of different things. I went on a bit of a tangent, but I hope that made sense, as we kind of round that little piece of it up.
I like
that's
that.
Just such a huge, bit of it that so many people overlook, and they look at this annual average growth rate, and they're literally killing themselves.
So the affordability index, that makes a lot of sense. And obviously when you compare it to Sydney and Melbourne and stuff, Perth has come from such a low base, right? So it gives people that opportunity to spend more, and it's got the capacity to afford.
And by the way, just right there, that was one of the other leading indicators for why we got into Adelaide and why we got into Brisbane when we got in there.
Well, that's what I was going to ask you.
Yeah.
That's what I was going to ask you. Is that the main indicator that you would use, or are you layering multiple indicators on top of each other?
Multiple.
So I'm just curious for the people out there, obviously.
So something could be super affordable compared to house prices, right? Like, give you a perfect example, like a mining town. The incomes are $5,000 a week, and the house prices are 200, 300 grand. It's because no one wants to live there. It's a shithole, right? Like, there's a huge imbalance there, but it doesn't mean it's the right place to invest. But when you looked at Brisbane, and you look at Adelaide, and you looked at Perth, in all their right points at the cycle to enter those markets, the balances were perfect, and there was massively, the supply was really starting to constrict. When that starts to happen and rents were starting to rise, there's all those factors that are then pushing all these sorts of people. Investors are getting into the market because rents are rising, prices are starting to rise, home buyers are now wanting to buy because their rents are going up, and so there's just all those different factors that are kind of accumulating into making it the perfect time to buy, which then starts to roll.
What about economic activity? Government, people, jobs, infrastructure projects. 100%. How important are those in relation to what you would say is the affordability?
So that's not so much around affordability. That is definitely a great point. It is one of, again, another one of the layers and the facets of what you want to put on and confirm that an area has stuff like that coming in as well. Because obviously when projects are coming in and things are being built and there's going to be more people in those areas as well, they are huge indicators that there's going to be increased demand in that area too. So that's huge, man. And big projects are especially a big part of it, especially when it's like a big project and there's a base somewhere in particular and people will live there and then kind of work off that as well. So that it always comes into it, especially, but it does always depend on the size of the projects as well. It is a big part of it. You also throw into the mix the things like immigration, that there is a huge pent up demand of visas waiting to come into the country as well. One of the important factors is like, it's your 3 to 4 big cities that aren't actually classified as regional centers in Australia, but all your smaller minor capitals are actually classed as big regional hubs and centers. So as well as obviously your big regional centers. So one of the interesting things to note is when these 2.2 million visas come in, if they are needing to work in regional hubs initially, they aren't going to your big cities. They're going to your small cities and they're going to your strong regional cities. And there is 2.2 million waiting to come through. That is a huge amount of additional pressure that's going to be coming in. There's a lot of people, there was this thing released a week or two ago as well in regards to student visas, student applications and at uni, no longer being eligible to do them. This is Chinese students to do them over there. So there's like something like 25,000 people, rushing to get back over. tightest vacancy rates in the country, you know, right now. Where are they going, you know, to do this, and where are they going to be housed? There's just all this additional pressure coming into these different areas. So figuring out where those nodes are that all those people are coming in, and where they're going to be going, and a lot of the time it's like, where are these guys going to be coming in for 2-year work visas so they can convert to permanent residency? Where are they going to be able to make the best money with their skills to be able to live? That's still a nice place to live and live a great lifestyle. When you can track and forecast and really pick those markets before they get hit with that, that's the sort of places that explode, both from a rental and from a price perspective as well. The rental perspective, because all the immigrants come in and they all need to rent, right? These migrants come in.
Well, they have to rent at the start, right? They can't just buy straight off the bat.
They need to rent for the first 2 years, right? And so all these migrants come in and they obviously need to rent for that 2-year period. So it pushes up the rents of that immediate, you know, in that immediate vicinity. So instead, all the nationals or the residents that are already here, they then go and buy because it becomes considerably cheaper, and then you just get this, you know, shooting up as it goes. So that's why, man, there's so many different layers and factors, and why, like, some areas might tick half the boxes and still have an exceptional growth run, and then another location may tick the other half and they have an exceptional growth run as well. There's just all these little different indicators you look and track at and forecast on.
So I suppose, just for the listeners out there, so you're really saying that there are a whole bunch of different either metrics or trends that you're tracking and you're looking at.
Yes.
But let's just look at, like, say, but then you have to lay them on top of each other to really identify the area, because let's look at supply and demand. You've talked about supply and demand just now with migration coming in, people taking up housing, the lack of supply. But if there's a lack of supply across the whole of the country, right, then you have to dive a little bit deeper, because there's a lack of supply in Sydney, but doesn't necessarily mean you're going to buy in Sydney. So that's when, is that what you're saying, is that you layer you apply the different strategy or the metric and say, okay, what infrastructure projects, what is the supply and demand, what is the affordability? So from a granular level, which leads me to my point, is when you're looking at, say, Perth, for example, you said the affordability, but then how did you then identify, you know what, we're going to target this bit of Perth, because that is the granular level which makes the difference, right?
Yeah, of course. So the big thing is what's going on the ground. You know, what's the sort of housing, what's the affordability in those specific areas as well? Where's going to benefit from ripple effects of better areas or better suburbs, and then the ripple effect of that then rippling into the other areas that are slightly more affordable, but only slightly further out. That's a huge change that happens in all cities, in all markets. When the most desirable areas become priced out and they can't afford there anymore, they go to the next one out, and then the next one out, and so on and so on. And it happens all the time. Every time a market goes through growth, those ripple effects are real. And a lot of the time, you will actually get more growth in those bottom end areas, because the people that are more used to paying more, and they get capped out of those areas, they just come in and they pay, you know, what they were able to pay to secure something in that next market down, and it just goes on and on and on. So these areas that are actually at the bottom get pulled higher than the areas at the top that only have that little bit of room to actually grow. That's where a lot of people, they don't realize. They think, oh, higher area, higher growth. It doesn't always work like that, and so often, like with that exact example, is the reason why it doesn't.
It's like fascinated?
It's like when people from Sydney, they go up to Brizzy and they go, holy shit, you can buy something 20K from a CBD for $500,000. That's crazy. But they don't realize 3 years ago, it was 250, 300 grand. You know what I mean? But they think it's so cheap for what it is, so close to the city, which it is. But like, you know what I mean? Like
they're just conditioned to paying that kind of money. So you're just saying that their ability to spend more in a market, and they will push that price up naturally.
Yes. Yeah,
it's funny. I think that's what I mean. On the sunny coast, people were buying off didn't even sight unseen, and just
everywhere, man.
Everyone from Melbourne was moving up there. No wonder.
I was laughing when I was getting outbid by people from Sydney, you know, moving up to areas of Brisbane. I was like, man, these guys don't know what they're in for, paying that much to come and actually live here. I was just like you should probably pay someone to go have a look at this thing and give you a bit of an area update before you go and live in there.
Sure. But, you know what? You brought up a good point before about, you know, not thinking that just because it's more expensive that it's a better property, right? Because I was chatting to someone the other day, and the previous buyer's agent they used them for their first property, and they went back for another deal, and that buyer's agent said, I've got nothing. There's nothing worthwhile buying under 600. If you don't have 600 and above, there's nothing worth buying. And I thought that was quite interesting, right?
Yeah.
So what would you say to some people out there? Because their lens at what they're seeing, they're loving the metrics and all the different things you're talking about, but they're like, Sammy, nah, not going there. I don't care what you say.
Absolutely ludicrous, man. The amount of money I've made in the bottom end of the market, be it 200, 300, 400, 500 grand, like the amount of money I've made in those markets has been insane. And the amount of money our clients, like that you've made out of buying into those markets and those price points is insane. It's nuts, man. And it's crazy when you look at the examples. I think the way like what I was talking about before about those ripple effects and those people overpaying or, pushing it up to those unforeseen sort of levels in those lower areas, that's where you can like make a ridiculous gain and then cash out of those markets before it cools back off. That's where you can make a ridiculous gain because of uneducated people coming in and kind of paying too much for those sorts of areas. But to say you can't make that much money in those markets, then I'll give you an exact example, right? And this is just relevant because it was 10 years ago. And, if you're looking at different markets and what you can kind of do, all markets move differently, right? But this is Sydney 10 years ago, 2012, I bought a piece of dirt, developed it in 2013, and it cost me all in about it was 355, right? It doubled in the first cycle and it almost doubled again. Well, it at least had that extra growth again in the last little COVID mini run. But man, it cost me 355. It was probably worth, I think it was worth low to mid fours at the time. Man, that property's worth 1.2 million in 10 years. And I paid so let's just round it to 360. 360 is worth 1.2 now. Like, don't tell me you can't make money in a 300, 400, 500 grand. Like he's talking sub 600. You could have paid retail and overpaid for that thing, which I would never recommend to do. But you could have overpaid for it and you still double your money. Man, it's honestly, it's absolutely ludicrous to even talk about that. And especially like when you're looking at different markets at different price points and different incomes, like the incomes in Sydney, let's even say they're comparable, or the incomes in Brisbane or Sydney, whatever, they're all comparable, but then there's different price pointed markets in those cities. The catching up, like it has to come, or the comeback of Sydney and Melbourne and those sorts of markets has to come because there's that disparity between income to house price ratio. And that's where, yeah, man, it's so often they'll come back a bit, they won't come back much because people will hang on as much as they can, right? And that's an Australian way. But what you'll find is a lot of people will be like, well, if I can't afford to buy there, I'll go move, let's say, into a different state or some different city or whatever, and buy it half the money and still make the same money or more and have less of the stress, from a mortgage perspective and everything. Yeah. And that's how a lot of these small cities then have their little runs as well.
Okay. The next question I've got for you, right? Does the metrics dictate the style of asset you buy? Like, does it change if you're looking at whether it's buying a house or doing a duplex or new builds or apartments, like just for the broad spectrum? I know that you're a big advocate of a certain type of property and don't, but are there different metrics that dictate different asset classes, or should it be the same across the board?
Do you mean different growth metrics?
Yeah, just for people that are looking and thinking, you know what, I really want to buy an apartment. So if I wanted to buy an apartment, am I looking at the same lens of what Sammy's talking about, the affordability index, supply and demand, all that sort of stuff? Do they apply to every type of property?
No, like I honestly believe, and I say this from personal experience of almost doubling the value of a unit that I owned, but looking at the growth percentage and the growth dollar figure that I would have had if I'd had a house in the same market, it's vastly different. And the markets are changing more and more as well. Like people say more and more people like to live in smaller accommodation stuff. I don't believe it because I'm looking at the growth rates, and you look at the growth rates of the last couple of years as well, houses like absolutely trump any of the other form of that style of housing. And maybe in your inner city areas, your terraces and your duplexes and things like that are kind of accepted and they're okay. But man, like houses, they just always outperform on that front. I think you mentioned new builds as in like duplexes and grannies and things like that. I think it's something like that. When you're talking about that sort of product, your growth is always impacted on those assets, right? Like that's I'll never deny that when it comes to that style of things. But are they in your portfolio for growth or are they in there for cash flow? If they're in there for cash flow and you're getting that cash flow result, and instead of getting 100% growth, you get 80%. The whole idea of that asset is to hold it forever and provide an exceptional cash flow for you. So if you still get 80% growth instead of 100, or even 60 or 70 or whatever, you still had a great growth run. You still had an exceptional result, but it's actually producing for you in a much different capacity in terms of your cash flow. So I don't even compare those when it comes to it, because I buy different assets for different points and parts of the portfolio.
Sammy, that's a cracker there, because
Thank you, mate.
It's very rare for you. But one of the big things I remember you telling me first early days was, and I often say this to a lot of the clients that call in, everyone, when they talk about property, are always talking about the where. They always want it. Where do you reckon? Where do you reckon? The first question, where do you reckon? Oh, I reckon, Jono said that, Macca said that you got to buy down here and all that. But further to what you just said, there was a little gem there, and you were specific about what kind of property you needed to buy at that point.
Yes.
And that's what I always find fascinating. The first conversation should always be, what do you need to buy?
Yeah.
And if you're needing to buy a cash flow property for your serviceability, or that property you're going to keep, then the where is irrelevant, first of all, because you don't even know what you're buying. So get the what right.
Yeah.
Do I need to buy this kind of property, which is going to enable me to move? Then we can decide where. So that's a really important layer, and an important point for people to understand is you really need to know what you're getting. Otherwise, it's too late.
It's a great point, because so many people, like, they kind of question different areas I put them into. And mate, you actually did this with me when we entered Brizzy, because it had barely grown for 10, 12 years or something.
Well, because I'd been burnt from it before. Remember the property that I already had? It was 100%. A lemon.
That was the wrong time to buy.
Say from the other buyer's agent, but Jesus.
But when you bought it, was the wrong time to buy. There were
like
other
a floundering fish on the shore.
Mate, there were better markets to buy in at the time, and that was the issue.
Mate, if I bought a rock in Melbourne, it would have been worth more than that place. Literally.
Oh, mate. But when we went in there, like, cash flow was what you were chasing. You were looking to replace the incomes. I was like, all right, no worries. This is where we're going to buy for these reasons, but this is the strategy that we're going to execute for these reasons. So the strategy we're going to execute, fulfilled your goal, and then buying in the areas that I wanted you to was because it would also fulfill what you needed overall from the portfolio. So I think that's extremely important to note. You can always get exceptional cash flows in a good, strong growth market. And mate, if that's what you need in your portfolio, because there's a lot of people now starting to run into, negative cash flow and quite negative cash flow. And if they can nullify that with a good cash flow asset in a strong growth market, you're literally going to get the best of both worlds. Like, I promise you that it's completely achievable.
And if we're doing full circle about how we started, about when people had said, oh, you just focus on cash flow. The reason why you were really focusing cash flow, and it took me a while to learn this, is because in order to continue to accumulate, you need to balance obviously the growth and your serviceability, which is obviously a direct reflection to your cash flow. So if you're going to continue to accumulate, you need both. So it's less about just focusing on cash flow for just liking cash flow, but it's going to help you get into more deals, right?
Yes, 100%.
So that was a massive learning lesson for me, if I can say. And I think a lot of people, when we're chatting to them, yeah, absolutely. Because you don't know, you just think, oh, I'll buy a good property in a good location. I'll sit around and wait 10, 15, 20 years and it'll be great. But then you're like, shit, I've been waiting 5 years for this property to do hardly anything. And I couldn't get into more deals because my cash flow, my serviceability was crap.
Yeah, man.
People have that
the
all
thing
the
is
time.
that comes into so many things, because it's just like, as you say, there's so many things. Exactly that. Like your cash flow side of things, where that's it. They're the only properties I'll hold to a double cycle, because like you think about the velocity of money, and I've always spoken about this, but you sit there and you stagnate for another 10 years, you do nothing with that money. Like the way inflation's going and whatnot as well. But even when inflation's at a normal target band, may you hold it for an extra 10, 12 years, like inflation erodes your profit. By the time you start the next cycle, you're almost back to kind of square one. Like, yeah, you've had that initial growth. If you've had your growth and either pulled out the equity or sold it down and recycled the debt and the equity, and bought two more in a different market and doubled again, you could do so much with that as opposed to just hanging on to it for the sake of hanging on to it.
Dude, I love that. I think we've nailed that one. I think we've nailed that one. Now, the next thing I wanted to ask you was, what are the indicators that are a waste of time? What are the ones that are just like, dude, what are you doing? Who cares? It's good.
Yeah.
I wouldn't be worrying about that. Some people get caught up in the analysis paralysis. They're trying to get every metric.
There's a bunch, man, that like I don't even bring into it. And I mean, it goes hand in hand with what I was talking about before. Which is historical growth rates, right? Like I'm almost the exact opposite. Like people love to talk about historical growth rates. This has, like I was saying before, 10, 12, 15% growth per annum over the past 10 years. Yeah, mad, man. That's great. If you rode through that, then that's fantastic. If you don't, enjoy watching it come back, because no market does 10-15% every year for 20 years. If you just saw it for 10 years, it's not going to do it again anytime soon. So get ready to shed a bit of blood on that one. If anything, it's the other end of the spectrum, where you're wanting to, all your factors line up, all your metrics, all your data, everything lines up. And then the other piece of the puzzle is that you're actually at a very low historic growth rate, which a lot of people, are scared of. Oh shit, I don't really want to buy in a market that's had no growth. But so often, man, it is the biggest predicator to having a fantastic run and making a nice discount on the way in and catching that early wave, which is where the most of the growth is. Man, that's what you want to be timing. That's what you want to get amongst.
Okay. All right.
That's really the big one, man. Like a couple of the other big ones. Sorry, mate, to cut you off for a sec there. But in terms of things I'd throw in the bin, that's the first one. I'd throw that in the skip bin, mate, and never look at that one again.
Throw it out.
But even things like like people talk about like your proximity to CBDs and your blue chips and all these different things like that. You're like those sort of metrics, and to me, they're sort of vain data points of like, oh well, I know incomes in this area are like the top 10% of the city or whatever. Man, those sorts of things, like I feel like it's more of a vain thing to be able to say, rather than actually being any sort of tangible data point or metric to really run by. So yeah, man, just those sorts of things, like the historic things and the vain sort of things that really have very little weight. They're the ones I'll be throwing in the bin pretty quick.
Okay. And you consider yourself an area expert. When you dive into an area and you really become an expert to know exactly how long, for people out there, because Australian Property Scout, the job of a great buyer's agent is to get you a cracking deal and mitigate the risk and all that. We know all that. But if people are listening out there and they want to become an area expert and they think, you know what, I can do this. I want to do this. I want to replicate what you did. Realistically, how much time would it really take to do the research, to identify the areas, and then to become an area analysis, an area expert, to then start investing? What do you reckon?
Mate, I track areas for a good 3 to 6 months before we even start like properly, like fully considering them. That's as a minimum. Some of the areas I'm tracking for over a year, 2 years before we actually kind of get into it, when you kind of see the metrics starting to turn exactly how you want. So you see different things that are sort of coming that are like, this is worth considering and worth tracking. You're probably looking at like minimum, I would say 3 months, if not maybe like another 6 months to properly learn the market in and out. I think it will really depend on your time that you can invest into it. So if you've got a lot of time to invest into it and can really put it on, get on the phones, potentially get on the ground and actually walk and speak to the agents, man, it's very important to note that a lot of the time there are different pockets within different markets that show good value. The biggest risk that you can do that will wipe out your first year's worth of growth if you get this wrong is you go buy into an area and don't realize there could be 3 or 4 different parts of that market. There could be the real bottom end shitbox area where you think things are just like really cheap compared to the rest of the suburb, but they're really cheap because it's a housing commission area with 60% houser, right? You don't want to buy in there. And then you might have your 2 middle areas, one sort of in the lower end of the middle that's still okay, one in the higher end of the middle, that's good. And then you may have like a top end part of that area. I'd probably be recommending looking into the 2 middle parts of the market to get the best value. But again, you've got to understand that market intimately, because if you get that wrong and you buy into one of the shit areas or the lower parts and you're valuing against the top end of the market, a valuer is going to come through and go, well, it's worth, in the middle of the lower end of it and kind of, that's what you've paid. It's not worth this part of the market because that's exclusive for a reason. It's 97% owner occupied. They're all 300 square meter plus houses, bigger blocks, blah, 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 all that good stuff. You know what I mean? So it takes time to really learn that and learn the intricacies. And a lot of the time, agents are out there trying to dupe, especially interstate investors that are buying sight unseen over the phone. So it's something to be extremely careful of. We've seen a lot of that. And it's something that you really want to kind of get boots on the ground and learn that stuff to not make that mistake. It's a very expensive mistake I've seen a lot of people make. So yeah, man, I think that's, realistically timeframes like your minimum 6 months, 3 months to pick your market. And then 3 months as a minimum to really learn it like the back of your hand.
I get that. Sorry, dude. What I was going to say is, and this is from my own perspective and just putting my hand up, before I met you and I was looking at property, and I'm sure there's people out there that are the keyboard warriors, they're doing all the research on Google, but because your knowledge is limited, and mine was definitely very poor.
There's still a big gap,
I was too scared to pick up the phone to make the call because I thought I'd look like an idiot.
Yeah.
And I think, how much weight would you say? It's all good to do the research and get on Google, but if you're not picking up the phones and having the conversations, because Jono says, oh yeah, by the way, this, oh, you got to do how important is that part of the research? Is speaking to people.
100%.
I didn't want to do it because I just thought I'm going to be an idiot. I'm going to sound stupid.
Mate, it's a massive part of it. Like if you're not at least picking up the phone, the people that buy via email and they're just emailing off offers and texting and all the rest of it, they're the easiest ones and the first ones to get duped. The ones on the phone, you've got a better chance of building a relationship and trying to have a crack with these people. But then I've always been an advocate. You know, I still do it myself, and I'm literally I was away last week and I'm away next week for the whole week's out scouting on the road, meeting agents, new areas that we're entering. And building those relationships. And like, if you're not doing that, like there's other people that are going to be doing that are going to be in front of you. You know, people like myself that you're never going to be able to compete with from that perspective. So like, if you want the best deals, and that's what you've got to weigh up, because realistically, like to get the best deals, that's what you've got to do to get the absolute best of it.
Yes.
But if you're happy to get something, you know, slightly below or around market value or whatever, then that's okay. Obviously, have your crack at doing it yourself, but just learn your market, because otherwise, you know, we don't want to see people getting burned of going out there and making that mistake. Like I said before, you know, paying in the middles and they're in the shit market, or thinking that they're buying the top end sort of stuff and they're buying that middle or lower end sort of thing. So, guys, just be really careful around it. And that's probably the biggest one when you come to the back end of it. Like, you can do all the research you want, just make sure you're buying in the right, I guess, area and location for one, but buying at the right price as well, or you're going to start behind the 8 ball.
Well, ladies and gents, he's done it again. The bull shark. He's been out. He's been out. Well done, Sammy. That was great. We said we'll do 20 minutes, short and sharp. And I think we just hit the 50. The 50 cent. We've already hit the 50s. Is there anything else?
Yeah,
is there anything
I've got
else?
one that mate, you didn't probe well enough out of me. I've got to bring it up myself. Then one of the biggest indicators, one of the biggest things to be wary of and to kind of potentially invest off or avoid investing off, it's actually policy change. So like policy change is a huge one. And by the way, mate, I'll make this one quick. I know we're getting to the end of it. But like policy change is like, it's a huge one. It's like such a fickle beast to kind of dabble with and play with. But it puts so much fear into the market, whether it's interest rate rises or whether it's land tax changes or whether it's negative gearing changes or an election coming up and all these different things. A lot of people don't realize. Sorry, mate?
NDIS schemes and stuff like that can potentially change.
Yeah, and NRAS. Like NRAS came in for a bit and people thought it was great. And they went and bought and then it shot them in the foot. Like all these different things, like they're things to be wary of, but they're things just like you stick your head up and you get on with it and you do what you're supposed to do. But you do always take them into account because they can massively drive markets. Even like as they play around with interest rates and whatnot, record lows, and now we're, it's probably the fastest it was ever risen in history, the way it's come up. All these different things, like in a way, they are policy change. Even grants, stamp duty grants and building grants and all these sorts of things, they are all in there to stimulate the economy and to stimulate sales and things like that, because the housing market is such a huge part of the economy. When it starts to falter, bang, new policy comes in, new grant comes in, this, that, whatever, to really drive it and get it going again. When it starts getting a bit too crazy and too far gone, or so bang, new policies come in, new changes come in to slow it down and chill it out a bit, because so much of our inflation rates and everything are also tied to that. So it's kind of like that fickle beast that they've got to balance and put in and pull out. The Queensland land tax was actually a massive one. And I remember you and I actually spoke about this. And I spoke about this with a couple of my kind of higher end investors, because a lot of people were pulling out and were getting very wary of buying in Queensland when they were talking about, when they brought this in last year. I just had this gut feel. I think I said it on a couple of podcasts or a Wise Wednesday or something. I just had this gut feel it wasn't going to stand, because I'm like, all the factors of why they brought it in and all the people it was going to affect, I'm like, they can't leave this in. Like it just doesn't make sense. Too many people are going to pull out of the market. People aren't going to buy investments there anymore. You big investors will pull out. There's going to be no rental stock, and your rents are going to go through the roof, and people are going to want to kill people. But no one's going to want to get back in because the land tax is going to kill everyone. And there was that on top of a lot of different things. And I just was like, this is not going to stick. but the market was crickets. There was no one around, and I remember speaking to a fair few clients that had that little bit more appetite for risk and the ability for it. And I said, I think we should be trying to towel up and take advantage of this quiet point in the market, because we're going to be able to pick things up for a song. And we did, man. We absolutely towed it up, and then they scrapped it. Like 3 months later, they scrapped it, and then bang, Queensland went nuts again, because it was like all this pent up demand. And then they've chopped it, and then boom, everyone kind of came in together. And it was crazy to watch. And that's just kind of like one example, but I mean, you look at all these different times, like the things that happened with COVID. You look at the election that came up in 2019. When things go on hiatus and go on a pause and everyone's worried, it's like, that's the best time to go out looking for bargains and for discounts and whatnot as well. So it's a really interesting one. And I guess as it comes to growth, like it's picking those sorts of things that kind of come with it as well. What potential policy changes are going to work in your favor or work against you, and kind of work in and out and around that as well.
Which I think it feeds into what you were saying before about a lot of people are saying, I'll wait for interest rates to come back. I'll wait for things to get better.
Yeah.
If you're going to be waiting for that moment, you're going to miss the opportunity, because everyone else is going to.
There's multiple markets. I honestly think people have already missed the bottom of their little period of pause, comeback, bottom. Yes. A lot of people have already missed that. There's some markets that are still going to have that opportunity this year, but man, you never wait. Like you buy when the time's right. You take advantage of disadvantageous situations. You get in there when others aren't. You always make more money than you ever will doing it when other people aren't doing it.
I've not seen a bull shark wait. So Sammy Gordon, there he goes again. What a way to finish off. He's quick to strike. You did it again, Sammy boy.
Jimmy, mate, it was enjoyable, man. I'm glad to have you back on for potentially your final episode ever.
Mate, I'm hanging by a thread. I'm living by a thread.
Oh, Luke, he's been requested for at least one poddy to see how he goes, so we might have to see. Mate, it's great having you on as always, mate. Great having you on.
It's good. I'm looking forward to the next episode, or when we're back on, because some of them just planting the seeds. I have been getting so many people saying, when are we going to do Sammy's next 3 or 4 properties?
And I've been getting people asking me, when are we gonna hear and dissect Jimmy's portfolio? Ooh. People think you're a fraud, mate. They think you're a fraud. They want to see what you've got.
Is my ex-girlfriend listening? Is my ex-girlfriend?
She's been texting me. They want to see what's under the hood. They heard there's a torn pet. They want to see if there's a 12-cylinder or if there's a Pee-wee 50 under there.
I think so. Yeah.
So guys, there's some great episodes coming up on the Scouting Australia podcast. Jimmy, thank you once again for joining us, mate. There's some big news coming up as well, guys. We are very close to the 1,000 subscribers.
No way.
We'll deliver.
Is it the worm?
The worm.
Is it the worm or the windmill?
No, the windmill's 10,000. It's 10,000.
Oh,
but
no,
the worm is coming, guys.
I'm going to fly up to Queensland for this. We have to get this live.
100%, bro. It has to be in the studio. So, guys, that's coming up very soon. If you haven't heard the worm, the story of the worm, I don't even know what episode it is. It's somewhere in the app. Go have a look. I don't know, it's 2 or 3 or something like that. Go have a listen to what the worm's all about. It's coming, guys. We're close to 1,000 subscribers. If you want to see the dance move that is the worm come out, I was in a previous life known as the Worm King of Wollongong, and it may come out live in the studio very soon.
So the Worm King of Wollongong.
There's a worm down the main street, mate, on a Saturday night.
Jeez, the worm. That wasn't his ex-girlfriend either. It was just the anyway.
Thank you very much for joining us, guys. Thank you very much, Jimmy. Appreciate it as always. Guys, if you've taken a lot of value out of this podcast, as usual, we would love it if you could leave a 5-star review on your favorite platform if you haven't left it yet. If there's anyone you think could take value out of this, or anyone you think you would like to share this with that would exactly that, take some value, maybe have a listen to it, maybe a partner, maybe a friend, maybe a parent or a colleague, please send it on. We appreciate you sharing the love. It's a great way for us to, grow the audience and also keep building your base of friends and your circle of influence thinking the same way that you do. I get told all the time, Jimmy does as well, all our bloody clients say the same thing. It's 90% of people say, mate, I wish I could have a conversation like this, like more regularly with my mates. But no one else talks about this. No one else thinks about it. I feel weird talking about it. Start sending these podcasts and these episodes to people you think you could that could take advantage from it and that you think could really benefit from it in your circle. Start building that circle of influence to support you and push you. Because as they say, you're the same wealth and the same net worth as the 5 people surrounding you. So try and build their knowledge base as well and really get them on the journey with you as well. All right, guys, please send in your questions for the Q&As as well. They're coming up soon. I'm looking forward to dissecting that again. The next ep with Jimmy is more than likely going to be in the studio. There is a potential for the worm. There's some big things coming, guys.
People, get in there, subscribe, send it to your mates. You got to see the Worm King of Wollongong. God, jeez.
It is coming, guys. For sure. It's coming. From Sammy Gordon and Big Jimmy, thank you once again for listening to the Scouting Australia podcast, and we'll be back soon.